Welcome to the Scientific Sense podcast, where we explore emerging ideas from science, policy, economics, and technology. My name is Gill Eapen. We talk with world's leading academics and experts about their recent research or general areas of topical interest. Scientific Sense is an unstructured conversation with no agenda or preparation. We cover a wide variety of domains where new discoveries are made and new technologies are developed on a daily basis. We are most interested in how new ideas affect society and help educate the world how to pursue a rewarding and enjoyable life rooted in science, logic, and information. We seek knowledge without boundaries or constraints and provide unedited content of conversations with researchers and leaders who love what they do. A companion blog to this podcast can be found at scientificsense.com, and this podcast is available on over a dozen platforms and directly at scientificsense.net. If you have suggestions for topics, guests, and other ideas, please send them to info@scientificsense.com, and I can be reached at gill@eapen.info. My guest today is Professor Christophe Faugère, who is a professor of finance at the Kedge Business School in France. He's the co-inventor of the required yield theory, RYT, a financial theory that provides more robust insights into the valuation of broad market indexes, such as S&P 500 and gold. He has published articles in leading American academic journals, such as Journal of Portfolio Management and Financial Markets, Institutions, and Instruments. Welcome, Chris.
Thank you, Gill. Thank you for this opportunity.
Absolutely. So I want to start with one of your recent articles, and it's entitled Making Sense of Asset Prices, a Guide to the Required Yield Theory. And you say the bad news is that there is widespread confusion about how asset prices are determined. And the good news is that required yield theory aims at establishing a clear understanding of the underlying mechanisms behind asset prices. Before we get to RYT, I want to look at the confusion you're talking about. So you say in the article, where do I begin? There is so much confusion out there amongst academics, practitioners, and the investing community regarding how to value stocks and other asset classes such as treasuries, gold, and real estate. That seems quite tragic, bordering on comedic. And I have to say, I could not agree with you more, Chris, on that. You know, when I think about the financial services industry, which is very large, as you know, in the US, they don't seem to really engage in an evaluation that their clients can actually see. Financial advisors sometimes claim they pick stocks for clients, but cross-sectionally, if you look at the data, such stock picking abilities have been shown to be value destroying, if at all. Financial intermediaries such as investment banks value assets by, they say, assessing market interest. Of course, the interest here is more how to get a share through spreadsheet magic from the innovator. And the more sophisticated, quote unquote, financial services industries, such as private equity firms or venture capital firms, who clearly have a need to value assets, also don't show any clear alpha from any of these activities that they do. So what do you mean by this confusion that appears prevalent, or in the industry as well as in academics?
Yes, I think there's fundamentally, I think people who work in the industry, they wear this badge of expertise, right? You go to see a doctor and they have this nice diploma on the wall, and you say, well, I defer to your advice because you're the expert. And I think there is some sort of that lure when novice people, investors that are pretty naive about the market, and they're looking for guidance. They go to these people. They could be brokers, investment bankers. They could be hedge funds, whatever, and they expect. I mean, they really believe that these people have a valuable knowledge that can help them essentially manage their money and get a decent return and moderate amount of risk. But that's really truly, I believe that's what most people think.
Yeah.
And so what happens is, I remember in particular one particular asset manager who is very famous. I'm not going to cite his name. And he is a Chicago School of Business PhD. And he, during the, I believe it was the dot-com crash. His fund was performing very poorly. And what he essentially was able to do is to say to his clients, we're going to do a lot of risk management, and we're going to manage the losses, to minimize the losses as much as possible. And in effect, he was telling them also, where else are you going to go?
Right.
You should trust me. I'm going to make the best of this situation. And but if you go anywhere else, you're not going to be better off. Essentially, was saying that they were all in the same boat. Nobody had a particular edge on understanding, not even making that claim, but on really finding a way out of this situation better than him. So essentially, he had like a captive audience. And then people, it's a big, in essence, it's a strong word, but it's also like a confidence game, in a way.
Yeah. You mentioned, Chris, which I see all the time, that financial advisors, for example, would say, this is a long-term investment, right? So you have been with me for some time, and you have to stick with me for a long time for me to actually help you. And you have to trust, like you say, you have to trust my judgment. I have been doing it for a long time, and so I know, so in this, the COVID situation is a good example, Chris. I want to get your perspective on this. The typical financial advisors have advised their clients that the markets are going to crash. And either they went into a very conservative allocation. And unfortunately, the day traders, there's 15 million of them in the US. And with joblessness increasing, we added another 15 million. So we have 30 million kids playing video games with the stock market. And it has come back. So what I heard some financial advisors say is that, a rise in the stock market like this is not sustainable. And so, we have to just stick with, what we thought maybe 6 months ago. And at some point, market will crash again, and we will be in a good position then, to get into the market.
Yeah, we can talk about the COVID situation because I find it fascinating. I think it's there is a strong parallel, not in terms of the narrative necessarily, but with 1929. That's my strong conviction, is that we're headed to a major market meltdown. And one of the, I discussed this with some of my colleagues quite often in the last couple of months, but there is something very intriguing about the month of October.
Right.
Most crashes, right, major crashes have happened in October, like the 87 crash, October 1929. There is something about the month of October, and if in the context of RYT, required yield theories, valuation, there is just no way the valuations that are actually occurring right now are anywhere realistic. I mean, you can't justify the market price at this time. I mean, it's impossible to justify it.
Explain RYT a bit then, Chris. So what's the formulation of RYT?
So RYT essentially, just to give you a little, I'll start with a little bit of the history of the theory.
Yeah.
My co-author, Julian Van Erlach, was a businessman, but very data-driven man. So in his business, he was in logistics, and he had a keen interest in financial data, and he was keeping huge amounts of data personally, and he was really testing his own intuition on that. And he came to me, just gave me a call one time, and I was at Albany, and he said, I have this explanation of how the market behaves, and it is based on this notion that investors at large want to obtain a minimum return of 2% real after tax. Okay, and I was like, I've never heard that before, but I'd be really interested in seeing what you have. And so he came and he showed me his data. He showed me his calculations, and I was very taken aback by what I saw, and I was very impressed by the due diligence and level of detail. However, he didn't have all the pieces together in terms of how to link up his intuition with what we understand in finance. He didn't really have the background and the knowledge, and so essentially it was up to me to kind of build this into a solid, with solid theoretical foundations. So the idea is really simple. The idea is that if you think about a market as being a corporation, okay? And think about somebody wanting to buy a share of that market. Now, what are they entitled to? They're entitled to earnings, right? So they're entitled to think about, in the really simplest sense, all profits belong to the shareholders. So essentially what we're able to show is that the earnings yield, essentially the inverse of the P ratio, is kind of like an expected return, okay? So we're kind of demonstrating this. It takes a little bit of while. But, and what we're showing is that if you're competing to buy that asset, you're going to bid up the price of the market to a point where you're going to say, okay, I'm not going to bid it more than this particular value because then my return is not going to be enough for me, right? So there is a floor that you're willing to go to bid up the price. And we're saying that essentially at the market level, this is happening, but this is also happening for individual investors. That is, the price is determined by the highest bidder. And the highest bidder is the person who's willing to accept that minimum return, but no less than that. And why no less than that? Because it is what the economy can produce as productivity. So we link this up to the productivity, the economic productivity. We're saying, for instance, 2%, right, is long-term productivity. And we're saying that essentially your wealth can grow at a maximum of 2% in the long term, because that's what economic growth, and that's what the rate of growth of corporate profits are in the economy. And we link up
on real terms, right?
On real terms, yes. On the per capita real term basis,
Right. Right.
So we're actually linking up this to and we're saying this is really kind of the return that everybody is essentially cornered into, because the person who bids and wins and defines the price is the highest bidder, and everybody's locked to getting that return. And the reason that it actually is that way is also because capital gains in the long term, the rate of capital gains is determined by the growth of corporate profits, which is also in real terms after inflation and that term. So we do a lot of we talk about dividend policy and what it is. I mean, it got us into areas where we had to say, well, why isn't it that people can earn more? What explains then the equity premium? What if this is 2% that determines the return on equity? Well, where's the equity premium? And we're essentially able to tie up all the loose ends. I mean, this took us about 7 years to do that, but and essentially what we find is that the equity premium is not something that gets added to the return on bonds, on riskless bonds, but that is essentially something that is subtracted from the return on stocks to get to the return on safe bonds as an insurance premium.
Mm-hmm. Mm-hmm. So let me understand the 2% a little bit more, Chris.
Yeah.
So what you're saying is that in the broad market, we can expect corporate profits to grow at approximately 2% on real terms in the long run.
Correct.
Right?
Yeah.
I had a bit of a difficulty, thinking about GDP per capita. You also argue that GDP per capita, we should see around 2% growth, only because GDP is a very imperfect measure, right, of economic activity, right? It just, perhaps, even though it's very imperfect, what you might be arguing is that it proxies corporate profits at the very high level. So you don't have to worry about all the mechanics underneath that, but you can just observe that at the very macro level, that's what you can expect to see.
I think that's the right argument, and the people people wonder also why are you saying why long term, why not GDP short term, and we're saying that actually GDP short term is linked to the equity premium, like the gap in growth between short-term GDP and long-term GDP determines periods of recessions and expansions, because you have accelerations, decelerations, and we link up these cycles, which we call business. We call it essentially a business cycle premium. And so we're able to tie that with the equity premium. But essentially what the surprise was that if we try to match, if we say, okay, the return that the investors want match, let's say, short-term GDP growth, there's complete disconnect. Actually, research has shown that there's not a tight connection between stock returns and GDP growth in the short term. But when we have this idea of essentially competing investors, short-term and long-term investors, for the same asset, right?
Yeah.
Then there is a minimum that they both want, and that is the long-term trend. They won't want to sacrifice lower than that. They won't want to get lower than that, except if they want to ensure, like for instance, if they want to trade, let's say at a short-term horizon, and they are saying to themselves, okay, I really don't want to have any risk and I'm going to go into safe bonds, and then I'm willing to sacrifice some return essentially paying a premium, and I'm going to get a little bit less than 2%, but that's the only time that I want to do that is because I have some sort of cash flow situation where I don't want to be in for the long term. I'm doing this. I have some sort of constraint, and I'm looking for insurance. But beyond, outside of that, the market, the big surprise was the market point to point is priced with this idea of 2%. That was a big surprise. Yeah.
That is, I mean, it is surprising, and it's very elegant, and it's really simple, right? In some sense. So this is in the absence of some kind of technology discontinuity.
Yes.
Right. So you're assuming productivity is really on a smooth, stable position.
Very good point. In fact, I would say, okay, one of the things that we say, and I'm just going to backtrack a little bit to when you were talking about what we don't in finance, why don't we understand valuation? Is because my analogy is this: we're on shifty sands. There's no solid base. Everything seems like it's moving. Like we're not sure that it's, that stocks are the present value of future expected cash flows. We're not sure about the discount rate. We're not sure about what those expected cash flows are. Everything is shifting, and we don't have an anchor. So what we said is we said, okay, that 2% looks like a really solid anchor, and we're going to trust it. We're going to test it, finding that it actually empirically works very well. And then we're going to learn from the model. We're going to say, okay, the times when there's a gap between the actual price, market price, and our valuation, how can we explain this? And this led to really some interesting insights. For instance, the effect of quantitative easing.
Yeah.
Now, it's a huge market distortion on bond prices and returns. And in fact, it's such a distortion that when we correct for that distortion, and we have some researchers, I think there were Fed researchers estimating kind of the gap between where the yields should be compared to where they are with quantitative easing. And I use some of those estimates. But when you correct for that, then the valuation gets back on track, which is very interesting.
Yeah. So explain that a little bit, Chris. So what is the goal of the quantitative easing? It's to push long-term rates down. Is that
Correct. But what they're forgetting the Fed is forgetting this, and I wrote a little piece on that a long time ago, is that people can do that on their own if they are fearful. So if you're fearful, you're gonna fly to safety, or you're gonna fly to safety long term, or you're gonna fly to cash short term, right? You can have both types of situations. But if you go long term and you buy long term treasury bonds, then you're gonna bring the yields down, and that's going to happen naturally because of that the market sentiment. And the fact that the people are saying, we're willing to take a hit just to get us into safety, right? And when the Fed is doing quantitative easing and bidding up the prices, it could be a situation where they are bidding up the prices too high for people to be able to purchase those assets in a way that protects them with the level of safety that they're searching, which would be driven by supply and demand, right? So you have a huge distortion in the access to safe instruments when you do quantitative easing.
Right. But more broadly, would you argue, Chris, that passive monetary policy is more optimum?
So can you repeat the question?
Yeah. So you would then prefer more of a passive Fed, right?
Yes.
In general, not just
Well,
in quantitative easing, but no.
yes, I would say, okay, so it's just a pure researcher question. I mean, when you have people like Milton Friedman and, I mean, the Chicago School who they're preaching, free markets, and that's an ideological position, and that's a political position. From a researcher standpoint, what I'm noticing that if the markets were free to act, then essentially the theory would work. See what I mean?
Right.
So it is not I'm not making a normative political statement there in terms of what markets, should market be free or regulated, or should there be intervention from the central banks or not. I'm not making any statement about that. I'm making a statement that I'm noticing that when they do, there's so much distortion that it just throws a curveball into the whole thing, and that people get even more lost because they don't even, there's even more moving pieces and they don't know what to do with them. So,
and so you I think you mentioned something like a fear premium.
Correct.
And so if I understand this correctly, Chris, are you saying that sometimes Fed actions could actually create fear in the market, and that could be sort of self-sustaining and feeding each other?
Well, yeah, I mean, not quite that, but essentially what I'm saying is that there could be fear in the market, which could be priced by the market, and the Fed, by doing quantitative easing, is introducing a skew in that pricing, and essentially leads investors to actually say, where else can I go if I'm trying to buy those long-term bonds and they're too pricey? What other asset classes? So it introduces a distortion in the search for hedging. And that's not intentional. And I don't think the Fed has even talked about that, which is really kind of scary, that they're forgetting this whole idea of that they're preventing hedging because they're hiking the prices.
Yeah, so I want to connect the 2% again to treasury yields and understand that a little better. But I want to also so the other kind of underlying assumption there is that the present value growth opportunities that firms have is mean reverting. So it's not really it's not going to be there, right? On a kind of a systematic way.
Yeah.
And we have already removed any kind of probability for a technology discontinuity. If that happens, all bets are off, right?
Correct. And in fact, yes. And to get back to that point, this is a very crucial point. And what I wanted to say is that since we're taking this as an anchor, we're essentially, we'll say we're true believers. We're going to say the model is true. And then we're going to make the adjustments. We're going to learn from the model by benchmarking it against reality, looking for the gaps and trying to explain the gaps. And what you said is very crucial because recently, in the last 3-4 years, I've been running this model. I've been testing this model with my students year after year after year. And everything works great. Make the adjustment for quantitative easing, works great. The tax rates, not ideally, but I don't have, there's the whole issue of getting access to the proper data and having, I would say, statistical institutes all around the world. There should be a mandatory list of things that they should be covering. And I think marginal tax rates there should be mandatory as macro data, but it's not in most countries. Anyways,
Yeah.
the point that you're making is great, because like I've started noticing that the gap between actual valuation, actual price, and the model was widening in the last few years. And I was like, I'm trying to make some adjustments. I don't understand why it's not working. And then I read these papers recently. I found these papers where this is, I think, European Central Bank, a couple of papers by central bank economists. They're saying there's a slowdown in long-term growth. So when you talk about a technological shift, it could happen both ways, right? There could be a slowdown and acceleration, right? And they're estimating long-term growth to be not 2% anymore, but 1.3%. This is after 2015, right?
Yeah, so I don't know if it's related, Chris.
Yeah.
I had a podcast last month, and it was really looking at, sort of a dissection of Tobin's Q, and trying to understand why firms are not really investing to grow their asset base. And one of the hypotheses that came from there is that the world population growth is slowing. Right. And if that is, we know it's slowing, and if it is going to slow more, some countries are already into negative. Most of Europe could be going into negative. Japan is already in a negative growth target. So this is not something that we have experienced before, population growth rate slowing, right?
Yes.
And that should have a long-term effect,
Correct.
I would imagine, on overall growth.
Correct. This is not data that actually I was aware of, in terms of population. That's really interesting information. I was going more in terms of what the current dilemma for a lot of the European countries is, to really ask the question of zero per capita growth, like flat growth. This is the flat growth model that's really kind of being more and more discussed by macroeconomists. And the thing is, to me, it's there are environmental constraints that are not necessarily being taken into account in terms of, like, when you talk about purely GDP growth. It doesn't incorporate the exhaustion of natural resources and things like this. So I would say there are limits to growth, like we know, and limit to population growth as well. So that I really was not, in terms of the model, in terms of RYT, I really was not questioning those long-term trends. I was interested in what some of the ecologists and geoscientists have been working on, in terms of energy exchanges in the biosphere, and and in terms of the accretion of energy, or the level of entropy, and how it is remedied by solar energy, and which maintains the whole thing into a sort of homeostasis. And I was looking for kind of a rationale for why that value of 2% seems to be kind of kind of a not a golden ratio, but kind of a golden percentage, which I saw also in France, by the way. In France, I ran the same simulations over 100 years in France, and it was 1.97% real return after taxes. I mean, this was a puzzle to me. And I was looking for some sort of biological foundation to this notion of productivity. But you're right. I mean, there are currently a lot of displacements, and we're going to expect more of these. And we can't take this long-term value as a constant, like we tended to do in our initial view. So another moving piece, but a slower slower moving piece, and we can we hopefully, you know, just like the cogs in a wheel, we have the big cog, the big wheels, the smaller wheels, and we can actually try to make the adjustments. But
yeah, it's very, very instructive, right? It's easy to internalize from a you know, sort of a framework perspective.
Yeah.
It's very elegant, and you know, now we could ask. So if you looked at 100-year horizon in France, that horizon covers technology discontinuities too.
You know,
sort of what we expect to see, right, in the future.
Yes, absolutely. I mean, it's essentially post second industrial revolution that we're looking at. So most of the technological displacements, well, the big ones, they've taken place. Of course, there's the internet revolution of the 1990s, which, by the way, you're absolutely right. I mean, I remember papers and books by William Baumol talking about the productivity slowdown, you know, in the 1980s. And then there's the internet and the computer revolution and the internet revolution. So I get what I get what you're saying, and the thing is, where do we stand in a closed system like the Earth system, and I mean, where do we go from there? I mean, is it, you know, like Earth ship ship Earth, or where are we going to go next? So these are questions economists. I mean, economists like to speculate. You know, they like a little bit of sci-fi, into especially the pure I would say the neoclassical growth economists. They really like to hypothesize that no matter what, we're going to find our way to higher growth and new technologies that are going to pull us out of this exhaustion of natural resources. So, but why not?
I want to shift gears, Chris, and talk about a couple of your other papers, which I find very interesting. So one of them is called Connectalism, a new paradigm for human choice. And you say that this is an introduction to Connectalism, a new paradigm for analyzing human choice. Connectalism is rooted in systems thinking and humanistic psychology. It melds together ancient and modern wisdoms about humans' awareness of their interconnectedness within the networks they belong to, the biosphere. And you put this in the context of what we are going through in this pandemic. Could you talk a little bit about what you mean by Connectalism?
Okay, yes. So again, a little bit of history here in terms of my personal history. You know, I was bred as an economist, neoclassical economist, and studied general equilibrium theory, which is the holy grail of economics. And essentially, when you're nourished in that type of milk, you're taking it. You're not being highly critical at first, and you're just taking everything as for granted. But eventually, my realization was that, and like many others, I mean, I'm not the only one to say that, obviously, that the fundamental economic models was lacking something, and we know that. We know from the failures of macroeconomic models, and from the micro is a little bit different because industrial organization, for instance, seems to have been fairly successful, you know, looking at game theory and strategic games and games that corporations play. I would say that's probably one of the more successful field even though nowadays people are saying, okay, evolutionary game theory, yes, it has worked, but it has also some limitations. Anyways, the point being that one of the fundamental tenets of economics is methodological individualism, meaning that we're looking at it making decisions based on its selfish utility in total isolation of anything else around it. Now, when I say in isolation, that doesn't mean there's no interaction. Of course, there is interaction because there's consumption and there's production. So there is interaction. But the decision that the individual makes is purely from the standpoint of his own well-being, independently of the well-being of others.
Yeah.
So one of the things that I learned about when I looked at some of the work by Maturana and Varela and some of the biologists and some of the systems thinkers is this notion of interconnection. That no man is an island, that we are tributary to the environment. I mean, we're constantly exchanging energy through our breath intake, through food intake, and we're giving and we're taking from the environment all the time. And we also are social animals, so we wouldn't be able to live in complete isolation. So there are those dimensions, which in a way, economists are considering to be kind of annexed. They say, okay, well, if you want to take care of these, you just add another argument in the utility function. Okay, you want to care about your neighbor's consumption? Okay, put it in your utility, and then it's all solved. And they're saying, well, but if you do that, what's the foundation? Why would you want to do that? This is totally ad hoc. And generations of young economists that have tried to break the mold, they've been criticized by saying, your model is ad hoc. Why are you making this assumption? Just go back to the basic where everybody is being selfish. Now that we know that, we're taking as being a fundamental holy truth. And for me, the holy truth is a biological truth of fundamental interconnection. And I started thinking, well, if we take this as a fundamental truth, then my decisions, depend on my awareness of that truth.
Right.
And so I would say that if we look at somebody like, it's a perfect case for me, somebody like Trump, and of course you're in the US, so I have no risk telling you that being in France. I hope you're going to escape from the censorship, but you see somebody who's really centered on himself, his very close family, and the interests of his family. And I would say to the expense probably of everyone else around. Now we may agree, we may disagree. That's a little bit my interpretation of what's happening. And I would say that in that vision, what we have here is we have an individual who behaves like Homo economicus, who's maximizing selfish utility and not being aware of his interconnection with the greater rest of society, and especially given his role as the all-powerful man that he is. So that's a very interesting example of somebody who doesn't seem to have that awareness or refuses to have that awareness, or for whatever reason, psychological or other, and makes decisions based on that narrow standpoint.
Yeah, but do you believe, Chris, that if you look at the population in general, do you believe there is an understanding of that network effect? For example, from an evolutionary perspective, the natural thing to expect, 50,000 years ago, essentially clan-based, small groups. They killed other clans, tried to kill off the other clans, and there is enough evidence, Homo sapiens coming out of Africa basically killed off Neanderthals and Denisovans. So Homo sapiens, if you look at their history, has been truly like that, and I sometimes wonder, do we have any data in the current context to say, yes, the modern society is any different?
Well, the only data we have is really from anthropologists and ethnologists and, people who go and go study particular tribes in northern part of the American continent or some of the islanders, and they're reporting on their understanding of their connection with nature and with each others.
Yeah.
Now, yes, the big question is, how much of that can be transposed to modern societies and Western societies and our mode of living and interaction? And
or does it scale?
Yeah. And
more generally, does
exactly.
it scale, right?
Does it scale up?
Yeah.
Well, that I don't have the answer to that question. What I would say is that it's probably not as clear-cut as some people think, where they say, well, it's obvious that I don't want to be going back to living in the jungle with a spear and and wearing fur from an animal and live by the fire, and that's, I think, where the perception of most Westerner lies when we're saying, okay, these guys, they have a different understanding of their connection to nature, but they're being judged. We judge them on their the appearance of their comfort of living and no technology or low technology or whatever, and we dismiss therefore their cultural knowledge based on this assessment of lower state of technology or primitive technology, and I think that's where the mistake is, because there are certainly are lessons that these people have that we need right now in terms of our handling of the ecological transition. And I think those people are going to do very well if we are, if we head to 2 degrees Celsius higher temperature by in the next 30 years or so. These guys are going to do much better than us.
Yeah, it's a model that we can learn from.
Yes.
But I think the necessary requirements there would be set of characteristics that the members of modern society have to have, right? So your other paper is sort of in the same vein. So it's entitled "Applying Mindfulness and Compassion in Finance."
Yeah.
You are truly an optimist, Chris. I have to say this. So you say, I inquire into the efficacy of adopting 2 mental aptitudes in the financial industry: mindfulness and compassion.
Yeah.
I define the noble aim of finance as channeling resources into the most deserving social or economic activities and raising community and societal welfare as a result. When I look around, though, Chris, I see no sign of this. So I can I can look at C-level execs of large companies, financial institutions, and I have seen them in giving congressional testimony. I have seen them on TV after dinner, talking about how distressed they are, watching sorts of financial, the wealth disparity in society that they believe is not sustainable.
Yeah.
On the other hand, they're spending most of their time trying to set up their balance sheets for the upcoming bailout, which is really a direct transfer from the marginal taxpayer to the shareholders of large companies.
Yeah.
So, I'm a bit of a pessimist on this dimension, but I think this is an aspirational goal, right?
It's a very aspirational goal, but at the same time, I think it resonates with a lot of the investors' appetites these days. I mean, maybe it's going to come from the millennials, or it's going to come from this generation, which is asking, to be accountable when you propose, when you're a financial advisor or you're ultra high net worth family fund advisor, or and they're asking you, what products are you proposing to me that are, that you can guarantee me are going to be accountable for being socially responsible and environmentally friendly and all this. I mean, these guys are, this generation, there's a generation now of 35 years old and less that are coming up, and they're asking the tough questions from the financial advisors. And I'm not saying that the industry is really genuinely wanting to follow these guys. I mean, they're really going there kicking and screaming. I really see that, but they have no choice. I mean, they're going to have to take the turn, and start offering genuine products. I'm working with just to let you know, I'm working not that closely, but with an organization in Asia, which is specializing in rating large financial institutions according to their social impact and their philosophy of investing, and we got big groups. We got like the BNP. We got large banks, very international groups that are occupying the space in Southeast Asia and some of those countries. And they're competing for these awards. And the thing is, I've seen some of those guys, what they're trying to do to avoid, to pass the bar, but really to do it in a minimalistic way. So yes, they want to get into that space because it's a marketing space that is virgin. But they're not necessarily making all the right efforts to do the right due diligence to offer the products, the right products. That's clear. But the bar is getting set higher and higher year after year after year. They're getting called on this. Year after year, they're getting called on it, and either they're going to do it or they're not going to do it. But if they don't do it, there's going to be some, clients are going to leave them and go to the people who are more accountable. I mean, the outfits that are more accountable. I truly believe that. So I think it's mostly demand driven, even though it's really a small part of the global assets investment, but it's going to get there.
It's a process, so we have to start somewhere. I want to quickly touch on RYT again one more time. So what is your, let's call it speculation? We have the market basically come back and exceed where it was even before the pandemic.
Correct.
So how do you explain this from an RYT perspective?
Okay, so RYT is clear on this. There is no way these prices are justified by valuation. Earnings expectations are down for next year. The growth is down. The prospects are down, and even accounting for a productivity slowdown, which I did in the model, I mean, the valuation is, and last time I did, it was quite a while ago, but probably in May, it was about 25 to 30% too high, okay? So valuation was just in a bubble range, okay? So my fundamental explanation of this is this. There is, if we think about optimists and pessimists on the market, right? Who's driving the market right now? I would say the people are in a bubble mentality. They're trying to push the price up or keep the prices up, and there is this notion of we have uncertainty and we have two roads. The roads is full recovery really quickly, or more of the pandemic and another round of economic hurt in September. And the hopes also are high for intervention of the Federal Reserve in some capacity, or even Congress to reallocate, some more money, with after the July 31st deadline, where some of the entitlement, or whatever it's called, the
unemployment,
is going to run out. But maybe it's going to be another round. I mean, I think people are trying to hope for an intervention from the government in one way or another to rescue the economy, and that's why I think the valuations are remaining as high. But
mechanistically though, Chris, can the government and the Fed in combination create growth in the economy?
No, that's just that is a complete mirage. So I totally I think that I saw, maybe I did not know about this, but I've seen a couple of articles talking about the Fed eventually wanting to be buying stocks, which would be a huge mistake. And I also think that I saw that Japan had tried that, and and of course you open the door to all the speculators who are going to catch the government their pants down, because when the government decides to stop throwing money in the market, then you get all these people who are taking short positions because they know it's going to go back to fundamentals, and they're going to make huge amounts of money. So to me, it's just delaying the inevitable. And the inevitable is that given the state of the way the government is running this response to the pandemic right now, which is extremely disorganized and also doesn't provide any sort of relief for corporations, or essentially there's no clear possibility to plan for any sort of investments, then what you have is fundamental uncertainty. And when you have fundamental uncertainty, people can stay on the side for a while, but then they make a decision. And I think that's a critical thing. People don't like to remain in uncertainty, and I think it's there's a bias in behavioral psychology called ambiguity aversion. You don't like to remain there, and so in effect, what happens is that you take an action just to get out of there.
Right.
And I think people are going to they're going to take an action, and the action is going to be probably to sell a huge sell-off in September and October. I don't see any other possible outcome for the American economy, at least, and the market.
Yeah. This has been great, Chris. Thanks so much for spending time with me.
Gill, this has been an absolute pleasure for me as well, and very. I appreciated the depth of the conversation. Obviously, it's a pleasure to talk about one's stuff. That the things where somebody's been working on their babies and stuff. So that's really of course. But I appreciated your intellectual curiosity and where you took me in this conversation. So thank you very much.
Great. Thanks so much, Chris.
Okay. Bye-bye.
Bye.